Hi guys, a very good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those were all of the top headlines that we're tracking for you this morning. We have a lot to talk about, but first let's go through what's happening as far as the global markets go, because there's been a lot of action there and we saw sharp cuts come through on Wall Street, which are now being reflected in the Asian markets as well. So the early trades are up on your screen. Taiwan, Hang Seng both seeing cuts of over 1.5%, and actually all major Asian indices are seeing cuts of over 1% right now. So even the Nikkei is down around 300 points. You have the Straits, which is seeing cuts of around 0.7%. Hang Seng, Kospi, like I mentioned, all of them opening sharply lower on the back of that weak handover from Wall Street. Let's also bring the SGX Nifty up for you now, and that is indicating a weak start for the Indian markets. A gap down 192 points is what we have on our screens right now. So let's see how it goes from here. But for now, it is over a 1% cut on the SGX Nifty. With that, let's bring you some important opinion for the outlook for emerging markets. This comes in from Mark Mobius of Mobius Capital Partners. Listen in to what he has to say.
If you look at the emerging markets index, it's been terrible. It's been underperforming. And the main reason is because of China. It represents 30%. As you know, China is in real trouble. It's probably going to get worse there. But what we do is look at individual stocks in individual countries. So, for example, if you have Indonesia outperforming the U.S., you're going to find some stocks in that market that will do fairly well against the U.S. stocks. So it's time now to be very, very picky in what you want to buy anywhere in the world, wherever you are, including, of course, the U.S. So the indices look bad for emerging markets, but individual countries, in some cases, are going to be okay.
All right, emerging markets overall look bad, but you will have to be very selective and look at an individual, take it on an individual country perspective. But with that, let's move on and also talk about Wall Street now. In the U.S. markets, we saw the trading session end lower. So the Dow Jones lost around 170 points. The S&P 500 slipped around 16 points at the close. And the NASDAQ was the underperformer. It saw cuts of around 85 points as well. Speaking of Wall Street, we saw bond yields surge with the 10-year jumping to its highest level since June. The rate on the 30-year Treasury also closed at its highest level since 2014. In fact, speaking of the U.S., we also have the dollar index, which is now above 110. So do keep your eye out on that as well. But let's now bring you some interesting opinion. The U.S. will outperform all markets, economies and currencies. That is the word coming in from Allianz's chief economic advisor, Mohammad El-Erian. So let's listen into that.
How resilient are we to the mess in China, to the mess in Europe? That's the key question. We know from Friday's report that the economy is resilient, but is it resilient to the headwinds we're going to face? The U.S. will outperform other markets, other economies, and other currencies consistently. People who want to fade the U.S. in favor of other jurisdictions simply don't understand the extent to which the U.S. is more resilient, more agile than other parts of the world. So I think the U.S. will continue to outperform. What I'm not sure about is what the absolute level will be, given what's happening in the rest of the world.
All right, the U.S. will continue to outperform. That's the word coming in from Mohammad El-Erian. But from the U.S., let's move on and also bring you what's going on with the European markets. They closed marginally higher on Tuesday. So the French CAC index is up on your screen. That saw gains of around 13 points. The German DAX surged over 100 points. And the FTSE closed with gains of around 13 points as well. So that's what's really going on in the European markets. Retail stocks were the best performing in the region. So the index saw a gain of 1.7%, while oil and gas stocks were the outliers. So they saw quite a cut. In fact, they were down 2.5%. We have been talking about the energy crisis, and on the back of that, we've seen these sharp cuts come through. Now, German industrial orders also declined 1.1% in July, so that's an important data point to track. And this marks a sixth consecutive month of shrinkage as the war in Ukraine continues to extend pressure on the activity in Germany. So that's really what we're tracking as far as the European market action goes. But that's everything that's happening globally. Let's talk about all of the cues that you should watch as we get into a brand new trading session. We have Sonal as well as Mangalam joining us now to take us through the trade setup this morning. Guys, a very good morning to both of you. Sonal, let me come across to you first. We were just going through the global market setup. Definitely looks quite weak this morning.
It does, and I'll repeat that actually in my market setup, because we saw that US markets, they opened after Labor Day break and they did not do so well. Dow Jones down 180 points, and that is something that is weighing on SGX Nifty also as we speak. Generally, we saw that 10-year bond yield that was at the highest level since June. We saw the 30-year yield at the highest level since since 2014. So yes, there is some pressure as far as the US markets are concerned. On Wednesday, of course, we'll get the Fed commentary on the current economic conditions of that particular economy known as the beige book. So markets are on the edge ahead of that commentary coming in from the Fed as well. ECB policy is also scheduled this week. So any rate hikes, any rate action is something which the global markets will watch out for closely as well. Asian markets right now, because of the handover that we got from the US markets, are in the red, hanging down anywhere between 250 to 300 points. We have Taiwanese index, which is down 250 points. Across the board, there's a lot of selling. And if we look at the SGX Nifty, a 200-point downtick is what the SGX Nifty is indicating. We have been doing really well, outperforming the other global markets. But today, it looks like we could be in sync. So it is below that support level of 17,500. Dollar overnight surged to above that 110 mark, and non-manufacturing PMI came in at 56.9 in the month of August versus 56.7 in the month of July. As far as our own markets are concerned, yesterday we closed flat after a very volatile session. Mid-cap index, however, outperformed, was up around 0.5%, and we saw the advanced decline ratio that was flat. 1:1 is what the advanced decline ratio looked like. We have the we had FIIs and DIs both net buying in cash markets. Now the support levels is at 17,500, with SGX Nifty indicates could be broken, and on the resistance level we have 17,750 to watch out for.
All right, Sonal, thanks a lot for running us through all of those cues. So we should brace ourselves for a weak opening with the SGX down 200 points. But let's see how we go from there. But Sonal, stay on. Also take us through some of the individual stocks that we should keep on our radar.
Oh yes, so I have a couple of them. Let me start with HAL. They said that they produce the gas turbines power for IAC-1 Vikrant. So Cochin Shipyard was in focus. This stock again comes in focus on the back of that big launch that we spoke about. Zuari Industries has signed an MOU with Envian International and Zuari Envian to build and operate a biofuel distillery. So that stock remains in focus. Pars Defense has entered into an agreement with Eldis Paradubis, that is in Czech Republic. It is signed to provide turnkey anti-drone systems for civilian airports in India. So more order inflow coming in for Pars Defense. GMM Pfaudler had an analyst meet where the takeaways were quite positive. This is largely baked into the prices, what the analysts say. The FY25 guidance is revenue of 3,700 crore rupees, EBITDA of 630 crore rupees, EBITDA margin at 17%, and the compounded annual growth rate for revenues is 14%, EBITDA for 24%. They also expect a return on capital employed at the rate of 25%.
All right, Sonal, thanks a lot for taking us through that entire list of stocks. We're going to keep our eye out on all of them. Finally, let's also bring Mangala Main, and he's looking at all of the cues from the futures and options space. Hi, Mangala.
Well, I'm looking at the one cue that everyone's looking at this morning, and that's the SGX Nifty down 200 points. So that's telling you there is a fair amount of nervousness. There was a lot of nervousness in yesterday's trading session as well. But for the record books, the Nifty closed flat after a volatile session. But, you know, the volatility was something that wasn't missed. After hitting a high of 17,765, the Nifty went all the way down to 17,587, a near 200-point drop from the highs before recovering to around 17,650 itself. Importantly, you know, if you just take a look at the way the cash market flows came by, we saw both the FIIs as well as the DIIs buy, but don't let that number fool you, because that could have been an element of you know, some sort of FII buying in the Syngene block deal that took place as well. So we had a 1,220 crore block deal in Syngene. What really stood out was the way the Nifty futures premium collapsed from 44 points to 27 points, and that was telling you there was selling by the FIIs in index futures. 1,000 crore worth sell figure coming in out there. They unwound 4,600 longs, added close to around 6,500 shorts. And remember, we were talking about how the FII longs inched up from 19% to 21%. Well, they've gone back to 19% with 81% of their positions on the short side. And that's not all. Even in options, the FII sold 67,000 calls. That's telling you there would be a fair amount of hurdles on the way up, whereas they unwound 18,000 short puts, and the SGX Nifty does indicate that. Where have they written those calls? 17,700 as well as 17,800, whereas the 17,600 put writers yesterday ran for cover, and we did see the 17,500 put writers being extremely active for a premium of around 50 odd rupees. So now that the SGX Nifty is opening 200 points lower, right in the zone of that 17,450 to 17,500. Let's see whether there could be support or not, because there also is the 17,496 mark, which is the 20-day exponential moving average. So that is an important support. But on the way up, we have retraced from levels upwards of 17,700 three times in the last 3 weeks, be it August 25th, August 30th, or September 6th. So that continues to be a bit of a resistance zone.
All right, we're going to watch out for all of these cues. Mangalam, Sonal, thanks a lot for joining us and prepping us up for this trading session. With that, it's time for our first short break on the show. But up next, the Roads and Transport Minister Nitin Gadkari says that seat belts will be made compulsory for all passengers in cars, including those sitting in the rear. More on that story when we come back. Hey guys, welcome back. You're still watching Power Breakfast. Now let's get you an important word. Just days after former Tata Sons chairman Cyrus Mistry passed away in a car accident, the Roads and Transport Minister Nitin Gadkari, speaking at a business standard event, has said that in order to make seat belts compulsory for all passengers in cars will be issued shortly, and those not following the new rules will be penalized. So let's listen in to what he had to say.
Because of this Cyrus accident, today just we have taken a decision that there will be that clip. तो सामने बेल्ट का आवाज आता है, लगाया नहीं तो पीछे वाले भी नहीं लगाएंगे तो भी वो चिल्लाते रहेंगे, आवाज आता रहेगा, तो पीछे और सामने दोनों को बेल्ट लगाना पड़ेगा. So we are now. So
it's going to be so one will be penalized if we don't do it in the car. How
100%, there is a provision for driver and the driver near driver seat. If you don't have belt, there is a fine. Now even the back people also, if they don't take belt, we will fine them.
Have you decided on the penalty?
Already, yes, I clear it.
How much is the penalty?
Within 3 days, we will issue the order.
How much is the penalty?
That is in the law. There are a lot of discretion. This is a subject in concurrent list. And there is a penalty from one amount to higher. It can be decided by the competent authority and the state government.
All right, definitely a good move there, right? Making seatbelts mandatory for all passengers in cars, and the order, like the minister said, will be issued in the next 3 days itself. But with that, let's move on and bring you another important conversation. Retailers are pinning hopes of the festive season as mobility is returning, and there are high ticket purchases as well, led by pent-up demand. My colleague Shilpa caught up with Venu Nair, who's MD and CEO of Shoppers Stop, and started by asking how the early trends of the festive season have been shaping up and how they're impacting sales and the company's growth outlook. So let's listen into that conversation.
Now the festive season having started, and as we all know, it starts from the east, and it is very, very strong, and that's something which gives an indication of what to expect. And I think there are a couple of factors which are playing in. As we all know, after 2 years, this is the first full festive period that people will have without the fear of COVID, and that's obviously driving people into the shops, into shopping and indulging, because there are parties, there are events that are happening, all of which had been in the pause mode for 2 years. So I think that's definitely the one big factor that is driving it.
And is inflation still a cause of concern, though, or do you think the festive season will see people coming out and buy despite inflation? And currently, what's the kind of impact that you're seeing because of inflation? Are you seeing that people are cutting back on their expenses and shopping lesser?
Inflation is there, and I think we all feel that, we all see that, and that's definitely a factor. I think the segment that we as Shoppers Stop operated, and we are in the premium segment of the market, and there I think the impact is slightly lesser, and because of the fact that again people are prioritizing in times like these, they prioritize on quality, they prioritize on brands, they prioritize shopping with retailers like ourselves who they trust. And I think that's what helps us, because when times like these come, when the value of money is felt even more, people would want to go back to what they trust the most. And I think that's where, being a house of brands, as a retailer which is known for its quality, known for its trust, and known for experiences, I think we benefit from that.
Right. And the footfalls, are they well beyond or ahead of pre-COVID levels now? And also with respect to billing per customers also, are the bill values also pre-COVID levels? Give me a sense of that.
In terms of footfalls, footfalls are certainly ahead of pre-COVID levels now, on a like-for-like basis, and if I remember right, they were up 8% in the first quarter, and that's the kind of trend that we have been seeing. Now that was 8% at an overall level. Like-for-like was level or thereabouts, and I think that's the trend which we are continuing to see. This was for quarter one, and a similar trend now. In terms of the absolute spends, and I think this is an area where we've definitely seen a big upsurge. We've now had 8 quarters of continuous like-for-like growth in the average bill values. Okay. So over the previous quarter of the same period, for 8 quarters now, we've had growing bill values. And that's telling us 2 things. One, that the customer is loving obviously what they see. And second, because of the fact that they love what they see, they're putting more items into the basket. And that's certainly something which we are benefiting from.
All right, so that's the Shoppers Stop management saying that festive demand is looking strong. In fact, the footfalls are even at levels that we've seen before COVID. They've surpassed those levels as well. So that's the word coming in. But with that, it's time for another short break. Up next, we're tracking all of the cues from the commodity markets. Stay tuned for that. Welcome back. You're still watching Power Breakfast. And as promised, let's talk about the commodity space. Manisha Gupta joins us now. Manisha, good morning and welcome back from your holiday. There's been a lot that's been going on and it's clearly all in the energy space.
Oh, absolutely, Pavitra. Thank you for that. Yes, the crude oil prices have clearly been buzzing, and the markets seem to have done the reaction from the OPEC and allies, which decided to cut output by 100,000 barrels per day in October. That did give us some support, but the markets have started to bring in losses. And as of now, the crude prices are trading at lowest since the month of Feb. The rate hikes, the weak Chinese demand is something that continues to weigh on, and all market eyes really are going to be on the ECB monetary policy meeting on this Thursday. So when you look at on a week-on-week basis, the crude prices are down by nearly 4.5% in the week. Gas prices have seen even further declines. We are down by nearly 11% on a weekly basis now, just about holding $8 per MMBTU. The UK gas prices have continued to decline as well. Here, the markets will watch out for the new UK PM to unveil the energy rescue plan that comes in on Thursday as well.
All right, Manisha, thanks a lot for getting us all of that action from the commodity markets. With that, we're going to wrap up on this edition of Power Breakfast. But as we do that, we leave you with a word from Citi's Ed Morse on what he has to say on the crude oil prices. Listen in and thank you for watching.
We have a different set of circumstances now weighing on prices, but also risking a higher price. The biggest one is the accelerating global recession. We haven't felt it in the U.S., but we felt the impact, as I said, of prices on demand. We're seeing radically lower demand around the world, and that is where the pressure is coming on prices. As we said, a recession can bring the price down not to the $82 level that we see WTI at the moment by the end of the year, but well under 70 if the recession really hits around the world, and things are moving in that direction.